How is it going, everyone? In this video, we are going to break down inducements. First, I will explain what inducement actually is and what it looks like on the chart. Then after that, we'll go through a few examples so that you can clearly see how it plays out in real market situations. So let's start with the definition. Inducement is basically a price movement that encourages traders to enter the market before the real move happens. Now, to understand this better, let's look at an example. In this case, price creates a higher low. When traders see this, many of them start thinking that price is about to move to the upside. So a lot of them FOMO into this trade and they start buying from this area. And a whole lot of them will place their stop losses here and they will look to target this swing high right here. But what usually happens is the price comes back, takes out these lows, which means the early buyers have gotten stopped out. Now, once price has broken below this low, another group of traders enter the market, and these are the breakout sellers. So once they see price breaking this low, they think price wants to continue pushing to the downside, so they start entering their sell positions and then they place their stop loss just above that breakout zone. But instead of continuing pushing down, price suddenly reverses and pushes back to the upside. Now, what just happened here? Price actually intended to move to the upside. But before doing that, it first took out the early buyers and the breakout sellers. In other words, the market first generated enough liquidity before continuing to the upside. Now, let's look at the opposite situation. In a bearish scenario, sellers see a level like this and then they start selling. And when they start selling, where will they place their stop loss? They will place it above this high. Eventually, what price does is price comes back, takes out their high, and now breakout traders, after seeing a close above this level, they start looking to take their trades. And then they place their stop loss just below the breakout zone and they look to target above. But what eventually happens is that price then continues in its original direction, which means price has actually engineered enough liquidity just by taking out the early sellers and then the breakout buyers before continuing in its original direction. Now, one important question is, why does inducement actually happen in the first place? One common reason is because price hasn't actually reached a point of interest, like a fair value gap, before these traders start looking to take their trade. For example, imagine price creates this low and starts pushing to the upside without tapping into this point of interest, which is a fair value gap. A lot of traders would actually start buying from this level because they don't want to miss out on the trade. So what happens is price comes back down, takes out the early buyers, and then taps into this fair value gap before it then pushes to the upside. Same idea can also happen in a bearish scenario. Traders will be looking to sell from this level because price created a high. And then what eventually happens, price then pushes to the upside, taking out early sellers and then tapping into the fair value gap before pushing to the downside. Now, there is another situation you would also see quite often, and this one, price would sometimes come back into the fair value gap or into your point of interest, just tap it a little bit and then start pushing up. Now, a whole lot of traders would think that this fair value gap has completely been mitigated and then price wants to come and take out this high. But what eventually happens is that price then comes back, dips below this fair value gap a little bit deeper before then pushing to the upside. And in a bearish scenario, price comes back into this fair value gap, just taps it a little bit and then pushes to the downside. Now, a whole lot of traders would think that this fair value gap has completely been mitigated That is why price is pushing to the downside. But this is just an engineered liquidity. So what price does is price comes back, dips above this fair value gap a little bit better before then pushing to the downside. Now that you understand how inducement works, let's go to the charts and look at some live examples. So this is going to be our first example, and this is the GBP USD chart. So first of all, as we can see here, price is clearly pushing to the upside in a bullish trend, giving us higher highs and higher lows. And right now, if price wants to continue pushing to the upside, then either this fair value gap or this fair value gap should be respected. So let's just mark them out. Now that it has been marked out, let's just wait for price to come back into one of them and then give us a reaction to see if that is a valid trade to enter. So right here, you can see the price clearly disrespected the first fair value gap, so we can delete that. And then you can also look at this fair value gap. You will just see the price just tapped it in just the slightest way possible. And then what eventually happened, price started pushing to the upside. So price hasn't even tapped this fair value gap again after reacting from it this first time. Now, a lot of traders will think that this fair value gap has completely been mitigated. So they will be looking to take their trades from this bullish engulfing candle. And then their stop losses will be around this level. And they will be targeting the external range liquidity. And now some other traders, let's play price forward again. Now some other traders will be looking to take the trade from here instead, which is this fair value gap, right? Where would their stop losses be? Their stop losses will go just below this swing low, or possibly for the conservative ones, they will place their stop loss at this level, right? And then they will target a 1 to 2 risk to reward ratio. Now, this is how price eventually played out. So here you can just clearly see the price took them out. And this shows us the price actually induced traders to get into this position. It's not like price doesn't want to push to the upside, but it's just that price has actually created a fake move first to induce traders to get into this first trade, and now they have gotten stopped out, so we should be expecting the main move soon. And now, how do we know that this is an inducement? When you look at this level, you would see that price could not close below that level. So price just tapped this area with just a wick, and now we should be looking to push to the upside. But the only obstacle we have from us getting to this external range liquidity is this bearish fair value gap. So what we are going to wait for is for price to disrespect this fair value gap, turn it into an inverse fair value gap. Then we'll be waiting for price to retest it, and then we'll be anticipating for price to get to this high. So that will be the anticipation. So let's wait for price and see what it's going to do. So here we can see the price has disrespected this fair value gap and it has turned it into an inverse fair value gap. So now we'll be looking to take our trade from this level. Our stop loss will go just below this, and we'll target either the external range liquidity or just a 1 to 2 risk to reward ratio. So let's play price forward and see how price eventually played out. And yeah, this is exactly how price played out. You can see price immediately got into our inverse fair value gap and went directly to our take profit. So this is the next example we are going to be looking at. So you can see the price left us a fair value gap right here, but this candle actually didn't tap into that fair value gap. Now, some of these impatient traders, they will be like, no, price has actually come back into that fair value gap, because after price gave us this tweezer bottom right here, we believe that price would actually be coming to take out this external range liquidity. No. That's what price wants you to think, right? Price wants you to enter this trade. And something else they are missing is that inside this bearish move that pushed to the downside, price left us a bearish fair value gap. Now with this bearish fair value gap, price is either going to do one of two things, which is price might tap into this fair value gap, then push to the downside, taking out this low and coming into this fair value gap before pushing to the upside, or we are going to see price disrespect this fair value gap, use it as an inverse fair value gap, and then push to the upside. As far as price hasn't done one of these two things, then you have no reason taking this trade. So let's see which one price does. So here, I want to take price back to this level to show you something. So here you can see that this candle was a rejection candle. What this also means is that price actually tried to close above this candle because of this wick, but eventually closed to the downside, which means this was actually a body close above this level at some point. So what this means is that some of these traders who don't allow price to close would have been looking to take this trade and think that this is an inverse fair value gap. And this is what I mean. So let's take price back to this level, and then we change this to the 15 minutes time frame so we can see each of that 1 hour candle in 15 minutes interval. So let's play the first 15 minutes. So here, this was the 1 hour candle in the first 15 minutes, and then this was the 1 hour candle in the next 15 minutes. So here you can see that at some point that 1 hour candle looked like this. So a lot of traders who don't allow price to close would be looking to take this trade as an inverse fair value gap, and then they will be placing their stop loss here and be targeting a 1 to 2 risk to reward ratio. But this is not the best way to trade it because price hasn't actually closed. So what eventually happened before price closed, we then saw this rejection candle, right? So now this is clearly showing us that price wants to push to the downside, and because we are already in an uptrend, I don't think this fair value gap would most definitely begin a bearish trend. So what this is just clearly trying to show me is that these lows will get taken out, price will then dip into this point of interest and then push to the upside. So let's see what price eventually did. And here you can just clearly see what I talked about. Price tapped into this bearish fair value gap, used it to dip into this bullish fair value gap while taking out these traders that looked to buy from here, and then it then went straight to our external range liquidity. In this example, I am going to show you how to use two different time frames. So the first time frame is going to be used for your point of interest, and then the second time frame is going to be used to determine inducements. So here we can clearly see the price is respecting bearish fair value gaps and also disrespecting bullish ones. This was the first fair value gap that price respected. This was also, when we zoom in, we would also see that this was the second fair value gap the price respected. And now price also has this fair value gap right here. But a lot of traders would think that this was a sweep of sell side liquidity right here. But this can't become, or you can confidently say that this is a sweep of sell side liquidity when price hasn't closed above this fair value gap, right? And because price is clearly in a bearish order flow, there is still the possibility of price pushing to the downside from this level. And also, according to candle science, we can also see the price closed below the previous candle's low, which is a bearish sign that we should be potentially coming to take out this level. So I would still be bearish until proven otherwise. So when I then go down to the 5 minutes time frame, which will be used as our entry, now we can also see the price left us with this high right here. So what would most likely happen is traders would have been selling from these levels because price hasn't actually gotten into this fair value gap before they started selling. So what would most likely happen is price would push to the upside, take out this level, and then immediately reverse to the downside. So let's see what eventually happened. Now, this is where I would want you to take note of. As you can see, price swept this level and then pushed to the downside. And this is where inducement really matters the most, right? For something to be an inducement, price needs to move away from that level impulsively. So as you can see, price took out this level. But immediately price took out that level, the next things we saw were impulsive candles to the downside, which clearly shows us that this was a sweep. This was an inducement. Price just came to take out their stop losses, and now it is aggressively moving in the direction it wanted to move to. So here, how could we have taken this trade? After this market structure shift, price left a fair value gap. We could take our trade from this level. We'll place our stop loss just at this high, or we can be more aggressive and place it maybe around here, and then we target the external range liquidity, or we just target the standard 1 to 2 risk to reward ratio. And this is exactly how price played out. So here you can see the price tapped us in, hit our 1 to 2 risk to reward ratio, and also took out external range liquidity. This would be our final example, and this is the GBP USD 1 hour time frame, and here we have a 1 hour bearish fair value gap which price created while in a bearish order flow. So we would expect price to come back into this fair value gap and then push to external range liquidity. So let's go down to our entry time frame, which will be the 5 minutes time frame, to then look for an entry confirmation. Now, in the 5 minutes time frame, a lot of traders would see this and think this is a valid liquidity sweep and this was an inducement, and then they will be looking to take their trade from this fair value gap right here. So this would be their trade setup. So they will take their entry from here, place their stop loss just above this fair value gap, and then they target a 1 to 2 risk to reward ratio. And the funny thing is, these traders I'm talking about, I was one of them. This was also a trade I took, and this was how price played out. So here you can see the price immediately stopped me out, and look at what price eventually did. So after price stopped me out and my other traders who took this trade, price then created a new bearish fair value gap just at this level, and from there we saw price push lower to the external range liquidity, right? And now this is also something else I would want you to learn. No matter how careful you try to be, things like this will still happen to you. And when we also delete this, you would also see that this actually formed the AMD formation. So this was the accumulation, this is the manipulation, and then after price reacted to this fair value gap, we then had the distribution to the downside. So this was more of price anticipating or waiting for traders to get into this trade, and then it stops them out before then pushing to the original direction. So just to quickly recap everything we have talked about, inducement is basically a price movement that induces traders to enter the market before it makes its actual move. And the main reason the market does this is to take out impatient traders and traders who are scared of missing out on a trade. It will just take their stop loss, collect liquidity, and then move to the direction it originally wanted to move to in the first place. Now, there are two reasons why this happens. The first one is when price hasn't tapped your point of interest, it first creates a fake move, inducing traders who are scared of missing out on this trade, and after price induces them, it then comes back, takes out their stop loss before then moving in the original direction that you wanted to move to in the first place. And also the second reason is price just simply wants to go deeper into the point of interest before then moving to the original direction. Another thing we talked about is inducements can be traded in two ways. And the first way is just by using one time frame, and the second way you have to use two time frames. The first time frame has to be for your higher time frame point of interest, while the second time frame, that is when you now go down to the lower time frame to look for your inducement levels. Now, the final thing we talked about is how to identify a valid inducement. Now, one way to confirm that something is actually an inducement is just by looking at how price reacts after it sweeps a level. So if price takes out a low and then quickly moves away from this level with strong impulsive candles, this is a sign of inducements. So what we are just going to be waiting for is for price to come back into a fair value gap, and then we can look to take price higher to then take out external range liquidity. Now, to identify an invalid inducement is actually quite easy. So instead of price taking out a low and then immediately reversing to the upside, we see price waste a whole lot of time after taking out this low. This shows us that this is an invalid inducement. Instead, this is a break of structure, and we might then start seeing price moving to the downside. Another way to identify an invalid inducement is the presence of a corrective move away from a level. Once you see this corrective move away from a low or a high, what this is trying to tell you is that this was a break of structure, and now price is correctively moving into a point of interest before then continuing to the downside. For something to really be an inducement, you need to see the purpose of it. So price has to first of all take out a low, then impulsively move away from that level, and that actually gives us our inducement. Anything that is not of that is invalid. So if this video made sense to you, I would love you to give it a like and subscribe, and I'll see you in the next one.